I was saying, I'm Pete Kroll, for those of you who don't know me, and I'm not in my normal office here, you can tell. I actually have been on a writing retreat for the last week and a half, almost 2 weeks now, trying to get my book wrapped up. So I'm out at Lake Appalachia and trying to get away from everybody and all the distractions. And I've actually gotten quite a bit done. So I'm really, really close to being finished, and I'm excited to getting that manuscript done and passed on to the publisher, and that book will be coming out later this year. It's called The Sustainable Investor. On that note, though, I will start our PowerPoint here, and we will get started. So give me 1 second. There we go. All right. Well, let's get the important stuff out of the way, the disclaimers here. And we will go through the agenda as we normally do. We'll give you an update on Earth Equity. We'll talk about the markets, any economic updates, of what we see going on, talk a little bit about portfolio construction, have a Q&A period, and then move on from there. So quick Earth Equity Advisors update. So I won the Luminaries with Heart honor back in December. That's my second Think Advisor award that I've received. I'm really grateful for those folks. I think that this one is connected to the work we do in sustainable investing. Had a chance to speak at the AAII, the American Association of Individual Investors Gathering in Raleigh early last quarter as well. On December 1st, actually I believe that's December 2nd, we rebalanced and reallocated the Green Sage. We do that twice a year. And like I said earlier, I am working on finishing up The Sustainable Investor. There's the cover of the book, and it's exciting to see. My training is in journalism, in communication, and so I'm used to short form writing, which is very, very different than long form writing, where, for example, with an article I write, it might be 600 to 1,200 words. Right now, this book is somewhere in the neighborhood of 53,000 words, which will end up being about a 300 to 340 page book by the time we're all said and done. Anyway, either way, it's a labor of love. I'm almost done, and I can't wait to put it in the rearview mirror. The other thing is we've certainly have made strides in this process, but we are actively hiring new financial advisors. We want to have folks in different cities across the country. We want to have people who are financial advisors for Earth Equity, who are helping people invest with their values in places like New York and LA and Denver and places where we think that they would be, really bring value to their communities. So that's a project that I've been working on in addition to a number of other things of late. Just a quick Asheville update. I consistently get questions about, how are you guys doing, et cetera. We continue to dig out. One of the interesting things, I was emailing with one of my colleagues up in Connecticut yesterday, and one of the things I said is, when I drive from our house in West Asheville over to our office space, which is in North Asheville in the Woodfin area, we drive right by the river. And so driving right by the river, the reality is that if we had been driving on the day of the flood, the water would be about 20 feet above the car, which is just sort of really crazy to conceptualize. But the reality is there was so much water coming through the French Broad River and the Swannanoa River, and so many areas in Western North Carolina that it just inundated everything. And, there's so much that still needs to be cleaned up, from buildings to, trees. One of the things I read recently is that 40% of our trees, at least in Buncombe County, were either destroyed or damaged. That's a major event. And when we think about the fires that are happening in California right now, a lot of what happened with those fires is something called the whiplash effect. So if you remember, Southern California had a whole bunch of rain last year. And so with that rain, we saw also a lot of vegetation grow up. And then suddenly they had a drought. All that vegetation dried out, leaving just a bunch of kindling and tinder to go up and really fuel these fires. And so that's a concern that I have in the Asheville area with all of these trees that have been damaged, suddenly pretty much doing the same thing. So, again, quickly, we're still digging out. There's still lots and lots of cleanup to be done. I think the Asheville Watchdog said there were, hundreds of millions of tons that still need to be taken care of. We did get potable water around Thanksgiving, so we were able to leave. I think it was the last time I did the quarterly call. We were out here at the cabin, so we were able to leave here and move back into Asheville for the holidays, and that's great. The team has done fantastic in terms of continuing to function with very little interruption during this time. And of course, we are grateful to everybody who reached out to check on us and who made donations to some of the great nonprofits and charities that were helping people in the area. Even though we had a lot going on in the fourth quarter, we were also really busy in the media as well. You can see, some big names that you know and some that you may not know, but we were really active thanks to Abby Sheridan, who is our person who gets us in the media for the opportunity to really tell our story. We're grateful for that. I recorded another episode. This actually is a picture of Rochelle Carson Begley, Ed Begley Jr.'s wife, out at their home in LA this past September. This is the 1-year anniversary edition or episode of Dollars and Change. So please, if you're not following the podcast series, check it out. It's available on YouTube. It's available on Apple Podcasts, and it's available on Spotify. And this is a personal reminder. So a lot of you know my wife, Melissa Booth, is a scientist. Well, she launched a series on the great courses back in November, I believe it was, called The Hidden Power of Microbes. So please, if you're interested in science, if you're interested in microbes, this 24-episode series is really good. I enjoyed it. I learned a lot, and I've learned already, previously had learned a lot from her, but this sort of was the icing on the cake. So thanks for humoring me for a second here. So let's talk about markets over the last quarter. So this is from the fourth quarter of 2024. Really only two areas of the market were up: large cap U.S. stocks and small caps to a certain extent, up about 1/3%. But everything else from emerging markets down about 7%, developed international down 8%. Bonds were down about 3%, which is not necessarily what we were expecting. With a drop in rates, we were actually expecting that the prices of bonds would go up, but for some reason that is not happening yet. We do anticipate seeing that happen. Certainly in 2025, we're hoping for that. And clean energy again did not perform. When we go back from a year, this is from the end of 2023 through all of 2024. The S&P 500, or large cap stocks in the U.S., did well, but up about 25%. But that's really, in the big scheme of things, about it. Small caps did about 11.5%, and everything else was pretty ordinary. 7% in emerging markets, just shy of 4% in developing international markets. Bonds were up about 137, and again, clean energy shares were down. When we take this out to the 5-year level, we continue to see a lot of the same trends where large U.S. stocks have outperformed, and the same thing is going to happen as we take this out to the 10-year level as well. The vast majority of the returns are coming from large companies based here in the U.S., and as we'll talk about in a minute, the majority of those returns are coming from just a few companies. Quickly, the inflation continues to moderate. I think that we're probably close to an area that you might even call normal at this point. There was a lot of fears in December that inflation might kick back up. Fortunately, it didn't. So it does appear to be under control. We dropped 100 basis points in interest rates in the fourth quarter. The question will be, what comes next in terms of that, and a lot of that's going to depend on what happens with the economy going forward. But for where we are right now, it continues to roll along. So like I said, inflation is back to normal. And we're in a pretty much a holding period to see what the Fed does. If they're going to continue to lower them, I think that they probably should at some point still this year, but it's probably not going to be the kind of interest rate drops that a lot of people were thinking, mid last year, or were hoping mid last year that we were going to see. But there is probably going to be some political pressure to do so. The new administration doesn't like the higher interest rates. And even though the Fed is an independent entity, I hope that they continue to maintain that independence. But at the same time, there is going to be pressure for them to lower rates. We'll see what happens with that. We can see that inflation has continued to drop, and it is back at a normal level at the level that is the average for the last 50 years or so. This is looking at a number of different economies across the world. The U.S., at 2.7%, we're maybe just a little bit higher than the Fed wants us to be, but in general, considering where we were, back in 2022 with these red numbers or red blocks here, we're actually in really, really good shape. And you can see what at this point is contributing to most of inflation, which is housing costs. You can see that's come down just a little bit from about a year ago, but still is making up the majority at this point of inflation. And one of the things that was a driver of inflation, especially during the pandemic, is things like supply times and supply chains. We can see that right now we're basically once again back to a normal level in terms of delivery times, maybe just a touch high, with 50 being the moderate number. And when we look at where goods are coming to us from, this goes back to 2000. We can see how much fewer imports that we've got coming in from China. It's dropped from about 22% down to about 15%. That's a considerable drop in imports coming from China, while at the same time other Asian countries have continued to rise. So we've really moved some of our manufacturing capabilities out of China into some of their neighbors. So the S&P 500 in terms of valuation, about the same as it was last quarter here, which is a little higher than actually considerably higher than the 30-year average. The 30-year average being about 17. We're about 21.5, which is over one standard deviation away from where we've been. But there are some, I don't want to say complicating factors, but there are some things that are different now than there may have been a while back. And I talked about this last quarter as well. The top 10 stocks that are in the S&P 500 have an overweighted influence on the performance of the S&P 500. So it's at the highest level that we can see in, going back all the way to 1996. Almost 39% of the S&P 500, which is 500 stocks, is made up of only 10 stocks. And so just to give you some background on what that means, so the S&P 500 is what's called market weighted. So if your company is worth more, it gets a bigger weight in the index. And so, the top 10 stocks, which I'll list off in just a second, have gained so much market capitalization that they vastly outweigh the other 490 stocks in the index, which also means that when you get returns and other things, they're outweighed also by those 10 stocks. The interesting thing, we can see that from a valuation perspective or a price to earnings perspective, the green, which are the top 10 stocks, they are priced a lot more richly, if you will. Their price earnings ratio being almost 30. And when you consider that the other 490 stocks, the valuation on them is about 18 times earnings. And so, it's 50% higher than the majority of the S&P 500 in those top 10 stocks. but at the same time, they're also a lot more profitable. So, this is actually focusing on the Magnificent Seven, which are stocks such as Apple and Microsoft and Tesla and Nvidia and a couple others that I'm not pulling off the top of my head right here. Anyway, but they are much more profitable. So they've got a 23.5% profit margin versus the other 493 companies at about a 9.3% margin. So they actually are more profitable, which would lead to them having higher price to earnings ratios, higher multiples. And of course, their performance has been considerably better as well. They were up 48% in 2024. The other 493 stocks were up 10% in 2024. And so there's a tremendous disparity of haves and have-nots in these indexes. So the top 10 holdings in the S&P 500, just to go through them real quick, Apple, Nvidia, Microsoft, Amazon, Facebook, or Meta, Tesla, Alphabet or Google, which actually has two share classes here, Broadcom, which very much like Nvidia makes and designs semiconductor chips that are used in AI, and of course Warren Buffett's Berkshire Hathaway, which is really the only traditional company, if you will, that's in the mix here. So I really briefly want to talk about the new administration that just came in a couple days ago. One of the things that a lot of people were worried about, for the past couple months were the threats of tariffs and things. And one of the things that I've been saying over that time is, let's be careful about what we're necessarily anticipating is going to happen, because a lot of this very well could be posturing. And so we saw that pretty much on day one, where instead of imposing tariffs, there was a lot of discussion about tariffs, but not anything actually taking place. So, there were several executive actions, a couple that I don't think were necessarily good. Number one, obviously, pulling out of the Paris Accords. Number two, pulling out of the World Health Organization, amongst a whole bunch of other things that aren't necessarily related to economics or the markets. But I think that we have to take a wait and see approach to see how things actually play out. Keep in mind that during the first Trump administration, sustainable investing actually did quite well. We doubled our business as a firm over that time. And one of the biggest reasons for that is people understood that action on the climate and action on sustainability in other areas weren't going to get done through legislative action. They weren't going to get done through governmental action. And what they did realize is that things are going to get done through corporate action. And the only way that you can participate in that is through investing in those companies that are going to be change makers, that are going to be companies that are providing solutions to obviously some of the biggest challenges that we're facing. And so, I don't want to get into politics too much. The reality is that whoever sits in the presidential seat doesn't have as much impact on the markets, on the economy, as I think we would like to hope that they do. Talking about the global economy, just to show you some of the share of, and maybe some of the dangers of isolationism, is when we look at, some of the things that go into everything, our electronics, for example, a lot of rare earths, lithium goes into batteries, not just for EVs, but also for things like your cell phone. And so it's really important to keep in mind that, we are truly in a global economy at this point. And when you look at the sort of green color here on this chart, the US provides 12% of rare earths, 5% of copper, 6% zinc, virtually nothing in cobalt, virtually nothing in nickel. And these are all, and nothing in lithium, although I think that we're probably transitioning that soon. But where we are right now, we have to be a net importer of these products. Likewise with semiconductors, even though we've seen a bigger investment in semiconductors, with the Infrastructure Act and some of the policies that were passed during the last administration, we're still producing only 14% of the semiconductors in this country. And so we are relying on others, Taiwan especially with Taiwan Semiconductor, but also South Korea as well as two of the biggies. And of course, China is in there as well. And there's another bunch of geopolitical issues that we won't get into related to China and semiconductors. And I want to go back to this imported goods by country because I also wanted to point out that Canada, of course, which is one of the threatened companies with tariff, interestingly has actually been decreasing over the last 24 years in terms of our them being a trading partner, going from about 18% or so down to about 13%. So that's a considerable drop. While at the same time, Mexico has continued to rise from about 12 to 16, 17%. And so one of the things that I think has always been interesting is from a trading partner perspective, it's much easier to partner up with companies that are, in close proximity to us. You don't have to ship things across the ocean to get them here. And that's always been an opportunity, I think, one that hasn't necessarily played out like I think it should. I love to throw in my random but important charts that are put together. And I do want to give credit to JP Morgan Asset Management. Every quarter, they put out their state of the markets. And pretty much, I think all the charts we've seen so far have come from JP Morgan. So thank you to their team. I've been out here by myself for the last 2 weeks writing. So talking right now is something that I'm not doing on a regular basis, so my throat's drying out. Housing inventories continue to be below their average here. They are coming up. It'll be interesting to see where we are with mortgage rates as we continue to move forward. Mortgage rates are can be a driver of this. When we think about it, I can use, for example, my my own situation. Our house in Asheville has a mortgage on it of about 2.6%. If I wanted to change out, if I wanted to sell and buy something else, but still required a mortgage, I would need to trade up from a 2.6% mortgage to a 6% mortgage or a 7% mortgage or wherever rates are right now. And so I think what that's doing is that's really keeping people on the sidelines for now. I think if we do see interest rates come down, I don't believe we'll see them go back to the 2.5% to 3% range anytime soon. But I think that we will probably see them moderate, hopefully in the 5% range, which I think is a fair mortgage rate for the long term. Then you'll probably start to see housing inventory start to go back up again. Electric vehicle charging points continues to grow. No matter what this current administration decides to do in terms of subsidies and things for EVs, the reality is that the investments that all the major car companies have made in transitioning and decarbonizing and moving towards an electric-based car market isn't going away. And so we're going to continue to see electric vehicle charging points in the US continue to proliferate, and we're going to also continue to see, because of that, uptake in EVs continue to move up as well. Maybe not at the pace that we'd like to see it or we really need to see it, but it should continue to grow. Household debt service ratio, love this. We continue to maintain relatively low debt relative to historic numbers. We look in Q4 of 2007, hitting almost 16% of disposable income. Now, we're down a third from there. And really since the pandemic, we've maintained some good ratios relative to household liquidity. We've seen a little bit of delinquencies start to rise again with mortgages. Excuse me, auto loans, credit cards, etc. We're probably going to see student loan delinquencies start to rise again now that debt is no longer being forgiven. Excuse me. But in general, especially relative to the last slide that I showed, I think that we're still in pretty decent shape. Unemployment rates are, continue to be at historic levels, historically low levels. So basically, we're at full employment. Good for the economy, will continue to be. Data center growth, I mean, as AI continues to proliferate as well, we're going to continue to see data centers growing, but also sucking more electricity. And so we have to be careful about how we continue to grow this aspect of the economy, and that we have the ability to power, these data centers and everything that's going to be associated with them, without increasing our climate liabilities. That is a challenge that we have, and it's going to a challenge we're going to continue to have. But more and more businesses are continuing to increase their use of AI, no matter how much we resist it. It pretty much is what's happening. I know I talked about this in the last quarterly webinar, but I really, really am excited about one particular area of AI use, and that's in drug discovery. And I've talked about this. I was on a panel a couple of weeks ago over in Charlotte, and I talked about it there. But the reality is that for any new drug to come to market, it costs about $1 billion and takes about 10 years. With the learning capabilities of AI, the ability to do testing in the computer in silico versus having to transition to in situ or in human testing, we're likely going to see AI be a driver of biotechnology. We're going to likely see the costs drop dramatically to bring new drugs to market, and we're likely going to see the time it takes to bring a new drug to market decrease significantly as well. Consumer sentiment and subsequent 12-month S&P returns. We're at a point right here where consumer sentiment continues to be a little low, which typically bodes well for the stock markets following that, once we, of course, get back to an average. And this is an interesting one right here. So every one of the portfolios that we put together has an international component to it. And we do that because we want to be well diversified. We recognize that a lot of the sustainability leaders aren't based here in the United States, that they are based in Europe and other areas of the world. When we look at the valuation of companies that are not in the US relative to valuations of companies in the US, the US is vastly overvalued relative to other international companies. But it's been like this for a considerable amount of time. When you look at the average, pretty much right in the middle right here, and the fact that we're 2 standard deviations below that means one of two things. It could mean either A, that international companies simply don't perform as well as companies based in the US, and it's not the best place to invest in general, or B, companies based internationally are vastly undervalued at this point and a potential opportunity for investment. And I tend to think the second of the two, which is why we continue to maintain having global investments or non-US based investments in the portfolios, because we think that there is potential for upside, especially when we see some shifts in political power and stuff like that. So it'll be interesting to see how this performs going forward. But I think this is a really, really interesting chart to check out and pay attention to. I love to talk about bonds. We've seen the interest rates, go up when we had inflation, and we've seen them come down. And this is a chart not only of what has happened, but what the experts think is going to happen over the next couple of years. Getting back down to about a 3% rate, long term, I think is a really good target. I think that's something that can be good both for economic growth, but also for people, especially retired folks who rely on fixed income to supplement their income. And if they can't do that because, let's say, we're back in 2020 or a few years before that, when interest rates were so low, it's really hard to find any fixed income or any stable investments that pay out any kind of return. And so I think the 3% is probably a happy medium there. What the previous bullet point said there is that our Earth equity portfolios duration is about 4 years, give or take, which is really where we want to have it. We want to have it between 4 and 7 at this at this place in the cycle. It's probably just a touch short, but we also don't want to add too much risk by making it longer either. Here's another chart from JP Morgan showing, pretty much yields for the last year, where they've gone, where they are right now. So in other words, say a 10-year treasury right now is yielding about 458. A year ago it was yielding 388. But while it was yielding that, we also saw negative 173 because that interest rate over that time period went up. Remember, there's an inverse relationship between interest rates and bond prices. And we can see, across the board, everything from high yields, which we make sure we've got a little bit of that in our portfolios, to corporates. Where's corporates? Intermediate grade corporates right here at 533. Lots of good opportunities right now to lock in some of these higher rates, because interest rates will be continuing to come down, albeit not quite as fast as we had hoped they would. Like I said, as interest rates rise, bond prices fall, and vice versa. So like I was saying, I think there continues to be an opportunity. We haven't seen rates drop as fast as we would have anticipated, which just gives us a bit more of a lead time, if you will, more opportunity for folks who might have bonds coming due or older bonds coming due, or who might have more money coming in, that we can position you in ways that we can set you up for 3, 5, maybe even as much as 10 years to get a nice steady income based on some of these interest rates that we see right now. And of course, the interesting thing, I love this chart because it shows movement in interest rates. So if we take a look, a 1% fall is the dark blue, and the gray is 1% rise. And these, of course, are in interest rates. So when we look at the 5-year Treasury, if bonds fall 1%, we can see potentially an 8.8% return, because the price of the bonds are going to go up when interest rates fall, and so there's a potential for a capital gain there. Likewise with corporates, a 1% fall can potentially equate to as much as a 12% gain when it comes to capital gains. So there's tons of opportunity, I think, here. And if this is something that that you want to talk to with your advisor about, please reach out. What we're seeing in California right now is just absolutely disastrous. I spoke about it a little bit earlier, talking about that whiplash effect. But think about this for a second. $250 billion is the estimate of what the damages are going to be. If this turns out to be accurate, just think about this for a second. The fires will exceed the cost of both Hurricane Helene and the entire 2020 wildfire season. And we're only in January right now. Think about where we are, and this is theoretically supposed to be the wet season in LA. I may have talked about this in the past. I don't think I have, but we've stopped calling it climate change and really turned it around to start calling it the changed climate. And the reason we did is because it has changed. And we saw it here in Asheville, we saw it in LA, and we're going to continue to see it more, not just here in the United States, but across the world. Because the effects that you've been warned about are actually happening. And so one of the things that I had an inspiration about, this is maybe about 2 months ago, give or take, is I was thinking about what SRI means. And when I got into this business, SRI stood for socially responsible investing. And it was a good descriptor at the time. And as it evolved, as we moved forward, we transitioned that to sustainable, responsible, and impact investing, which I think was really broke down a little bit more about what we were trying to do. But as we move into a changed climate world, I think that we also need to transition it one more time. And so here's my new definition of it that you'll see coming from us pretty much going forward. It's sustainable, resilient, and innovation. And the reason I throw resilient and innovation in there is because I think that is where we need to be now. So sustainable is about mitigating the risks. It is about creating a world and creating an economy where people can thrive in, and where we're not borrowing from the future to take care of where we are today. Resilient, though, also acknowledges the fact that we are having the fires in California, that we did have a massive hurricane hit Asheville. And we have to be able to be resilient to the impacts of the changed climate that are happening now. We have to be able to adapt better, and we have to be able to rebuild better. And so there are opportunities in really resilience and adaptation that really need to be integrated into the concept of SRI. And finally, innovation is really the glue that holds all of this together, because innovation is going to help us on the mitigation side. It's going to help us on being more sustainable, but it's also going to help us on the resilience side. It's going to help us to make sure that our systems, that our buildings, that our processes are going to be more resilient and adaptive to the reality of what we're dealing with today. You've probably all seen, if you're watching this for more than the second time, you probably have all seen my friend Wayne here talk a little bit about we want to invest in a way to skate to where the puck is going, not to where it's been. And so, as we're conceptualizing and thinking about the sort of the new idea of SRI, a lot of what we've done in the past remains the same, but we want to invest in clean energy. We want to invest in energy efficiency. We want to make sure that we have access to batteries, not just for your EV, but also utility scale batteries. Making sure that we're able to have a grid that is resilient. So when we have cold temperatures like we're currently having, that the grid is able to hold up and not crash because we don't have adequate supply. Water. When we're dealing with a changed climate and we're talking about different weather patterns and how things are going to change from water vapor in the air and a number of things. Water is going to be a really, really important resource that we want to make sure that we have got a toe in, if you will, but mostly focused on distribution, filtration, and efficiency. We need to use water much smarter. Green transportation is an easy one. Infrastructure, talked about that just a moment ago with resilience and adaptation, making sure that we're ready for the storms and for the impacts that are about to hit us. Natural and organic products and services, sustainable real estate. Our buildings are a third of our emissions. How can we continue to reduce that? Information technology, this is about efficiency. How can we make our systems and processes more efficient through better use of technology? Green finance, insurance, and community investments. I'm not going to talk about insurance too deeply, but if you live in fire-prone areas, if you live in hurricane-prone areas, getting insurance is going to be harder and harder and harder. And so, we want to own companies that are integrating climate risk into their underwriting capabilities, into their underwriting processes, and insurance, and making sure that people have access to finance to put solar on the roof or whatever it might be is really important. Recycling and circular economy, trying to eliminate the concept of waste. Talk a little bit about real estate, but also the green building technology that goes into buildings. And of course, cutting edge biotechnology. I talked about AI earlier. We don't quite have an investment in that yet, but that is something that is definitely a potential down the road here. When we put together our Green Sage sustainability portfolio, we want to make sure people understand that it is not just a portfolio focused on green energy or something specific. It is a broad-based portfolio that has pretty much every single member of the S&P 500 from a sector perspective, except the fossil fuel industry. That's the only one that we won't invest in these portfolios. It tends to be a growth investment. And so let's move on to, how are we handling the current market environment? So we rebalance our fund portfolios every quarter. So we rebalance those the first week of January. And when we put those together, the equity portion of it, we break down by domicile, we break down by size, and we break down by thematics. So when we put these portfolios together, there's really two parts to the stock side or the equity side. The first being the core portion, where we buy large companies in the US, where we buy international companies, where we buy emerging markets, whatever it is. And that's the core part of the portfolio. But we complement that with really four areas that really are important to sustainable, resilient, and innovative investing. And that would be the energy transition. That's going to be water, it'll be biotechnology, and be infrastructure. The things that we just talked about, we make sure that we have a specific fund that focuses on those thematic areas. The bond allocation, we will break this down by quality, duration, what the yield, what the domicile is, and also what the focus is. We have funds that are focused on climate bonds. We have funds that are focused on high yield bonds, different things like that. And we complement with alternatives. Alternatives are investments that are not correlated. They tend to be to not move in the same cycles as the stock or bond markets. And so when we have volatility, the idea of having alternatives in there is that they will moderate some of the volatility or some of the risk. And so we have a number of different portfolios, 5 specifically here, and they are all gauged by risk. This is on a scale of 0 to 100, with conservative being down here at 48, all the way up to green sage, which is going to be our most aggressive, at an 85, and everywhere in between. And we can bring these down lower if necessary by using bonds, by using Calvert Impact Notes, and by using a fixed and alt investment portfolio that we also manage. Correlation, I talked about for a second. When you look at returns, absolute returns for funds and for portfolios, you can look at one here, say, from a 60% stock, 40% bonds, that is getting on average, let's say, not 8.5%, with a 9.5% volatility. But when you add the alternative investments to there, when you add the currencies, commodities, different things like that, you actually are able to slightly increase your potential return while at the same time reducing your volatility. And so that's why it's so important to sort of marry non-correlated assets with other assets that we would normally have in the portfolio. It's at the end of the day in your best interest, and we try to do so in as responsible a way as we can. So let's look at fund performance here. So 2024 was a little bit challenging in the fourth quarter. There was a lot of volatility. Luckily, the alternative investments that we have did help. So this was one of those situations where those non-correlated assets actually performed nice and did their job. But the 1-year plus numbers are really moving in a positive direction, so we're happy with that. And clean energy stocks continue their underperformance over the last 4 years, which is really unfortunate. We've been able to moderate the negative impact on our portfolios by simply decreasing some of the allocation to those areas. We did add an infrastructure fund to the thematic portion a couple weeks ago at the first quarter rebalance of 2025, and I'm hoping that will be a good addition to the portfolios. But long-term performance is in line with our expectations, and risk models will make tactical changes if necessary. But we can take a brief look here. You can see that there was a lot of red in the fourth quarter. But when we take this out to a year, 5, 10 years, we've done, I think, pretty well relative to our benchmarks. Let's take, for example, let's look at the 5-year here on Brown Advisory, which is the large cap growth fund that we use. 1592 versus its benchmark of the S&P at 14.5. Same thing at 10 years, it's outperformed. And since inception, it certainly has as well. And it's done so with just a little bit more risk, but not a lot. Let's take a look as well at, say, the Janus Henderson Responsible International. So this is international markets. If we look again, let's look at the 5-year. Actually, we can look at the 1-year too here. It's done well. So EAFE is its counterpart, up 382 versus 888, 665 versus 473, 643 versus 520, and 744. Is that right? Yeah, 744 versus, so we've outperformed or underperformed a little bit since inception. They're probably different dates, so that's hard to really judge. Let's look at bonds. Sorry, I'm losing my voice here. But just about everything outperformed the U.S. aggregate bond index, which was only up 134 on the year, down 310 in the fourth quarter. Our climate-focused bond up 4, flexible bond fund from Calvert was up 6.5, and high-yield bonds were up 747. And we see pretty much the same thing across the board. Again, inception isn't necessarily a good indicator because they're all different dates. We can look at 5-year though, 329, 383 versus -35. And our alternative funds, again, all did fairly decent. And when we look at the fourth quarter, they were all in the green relative to a bunch of reds on the equity side. And at 1 year, I'm very happy with these kind of returns. When we look at asset class returns in general, I always love to look at the white, which is an asset allocation mix. It's a mix of stocks and bonds. And you'll notice that, like, for example, in 2023, it was up 14.1, 2024 it was up 10. So you can't judge this based on where the number is relative to the year before. It has to be judged based on relative to where everything else is in that particular column. And so, last year, an asset allocation portfolio, which is a mix of stocks and bonds, returned about 10%. Well, what I really wanted to break down for you here, just briefly, is look at the disparity. And we talked about this right at the onset of the webinar today. Large caps returned 25% last year. The next closest style of investing, small caps, was 11.5%, less than half of what the returns of large caps. And remember that this return was driven by 10 stocks, very possibly 7 stocks, but it was driven by the very small minority of stocks. And so, when we look at the rest of the different styles, from high yield bonds to emerging markets, commodities, cash, real estate, developed market stocks, and fixed income, there's a huge disparity here. Long-term investing pays. When we look at any 20-year rolling period, there is not a negative return for stocks, bonds, or a 60-40 portfolio for that matter. And we even if you just look at a 5-year return, over a 20-year rolling period, it's still only a -2% return in stocks over that period, but the potential upside of 29%. And when we look at timing the market versus time in the market, I love this, and I use this one every quarter if you've been around with us for a while. But if you were invested all days from January 2003 through December 2022, you went from $10,000 to $64,000. But if you missed just the 10 best days during that period, you took your return from 64, almost 65,000, down to 29,007. So less than half, just because of 10 of the best days in the market. And you can see, as we take an additional 10 days off for each one of these periods here, if you missed the 60 best days, your 10,000 ended up down almost 60%. So a big difference about, instead of trying to time the market, just putting money in, specifically, potentially using what we call dollar cost averaging, putting a little bit in over time. It certainly doesn't hurt as well. So to summarize, we're going to continue to keep a close eye on the economy, U.S. and international politics, like we typically do, but especially, decisions of the new administration, how it might affect us, how we can take advantage of any particular decisions or policies that they might make. We'll make tactical changes if and when it's warranted. Not anything that I necessarily see happening, but we also didn't see the pandemic happening either, and we made tactical changes during that time. Of course, we are super grateful for your business. We wouldn't be here without you. So thank you. If we want to go to Q&A, we can transition over to Q&A. I see one question here. How do you see insurance concerns connected to climate change impacting the U.S. economy? Great question, Scott. There's a lot of potential negatives to that because we're going to see people who aren't able to get insurance, and there's going to be some point. Let's talk specifically about the coasts, where the only people who are going to be able to really have a house on the coast is people who are wealthy enough to self-insure, because the insurance companies simply aren't going to cover what you know they're not going to cover risks that don't make sense to them from a financial perspective. And so that potentially has a negative impact on the economy. Um, we're going to have to come up with a way somehow to figure out how to move people, if we can, from high risk areas to areas that are going to be less risk. Now, as my wife said on or on NBC recently, there's no such thing as a climate haven, but there are areas that are, from a relative perspective, are going to be maybe a little bit less risky than other areas. And so um, there's both risk and opportunity here, but I think the risk is the greater side of things. Will it affect the economy? I think over the long term, yeah, it's going to negatively affect it. In fact, that was one of the things that I was reading about and did a little bit of writing about on the book today. Any other questions? That's unusual. We normally get three, four, five questions. Well, if nobody has any additional questions, I will give you 7 minutes back that you can enjoy with your day. I want to thank everybody for spending 53 minutes with us today here. I want to thank everybody for their business. I've got some colleagues on here. Oh, we just had a hand raised. Well, I guess not. Anyway, I want to thank everybody for showing up again. We've got some colleagues here. We got some friends here. We appreciate everybody's business. If you're a client, thank you so much. If you're a prospective client, we certainly would love to work with you. Please make sure you follow up with us after the Zoom here, and everybody have a great day. Thank you so much.